We're snorting cap rates and shooting up cash flow here at Deal Junkies. Hi.
Hey.
Welcome back to Deal Junkies. We are back in the studio. Well, some of us. Mike Nuss is here. Dane McKinney, Gabe Johansson. We just got back from a Scandinavian adventure. I wanted to take something out of Dane's playbook and actually go enjoy life a little bit. So we planned a trip. This is like a trip of a lifetime. By the way, like we were gone for a couple of weeks.
The Northern Lights shot.
That was pretty cool.
Whoa.
So that was sort of the key focus to go look at the Northern Lights. I think you can go to other places closer than this to see the Northern Lights after I researched it.
Yeah.
But we decided we wanted to go see them in northern Finland. We were 20 minutes from the Russian border. We drove a stick shift 9-passenger van all the way to the northern border of Finland.
Yes.
And we laid in these cabins with glass roofs.
Yes.
And we watched Northern Lights. We did that for a couple days.
Too.
You couldn't do that for 2 weeks. So we did that in the middle of our trip. We started in Norway, we went to Finland, then we went to Sweden. So we took that play out of Dane's playbook and went and enjoyed life a little bit. Trevor didn't come back. He stayed in Sweden.
He's going to be so jealous because all we're going to do is talk about deals today.
Mm-hmm.
Oh, deals. Yeah.
I'm glad you guys are back. I missed you, but I was happy you're going.
We were going to record a podcast in Sweden.
Yeah.
And that just never happened.
Did not happen.
We stayed on the run.
Every day it was the best thing because we would all be standing in a group, like all six of us would be standing there. We'd be doing like the thing that we had planned, and then we would have like 5 more things that everybody had kind of individually been like, it would be cool to do this today too. And then the girls would be talking about it, and then Gabe and I would be standing there listening to him talk about it, and they'd be like, okay, so we're going to do this, and then this, and then this, and then this. And we would both just be like, it's going to be 4 a.m. We have no time to do all of those things. We have to walk to all of those places, and then it takes 2 hours to do what you're talking about. Yeah. So we got a lot done, but not work.
It was me, Trevor, and Dane, and our ladies. And I'll tell you, the hardest part about it is the time difference.
Oh my goodness!
So we got there, and like the first night, I'm texting Dane at 2 a.m. I'm like, "What's going on?" He's like, "I'm hungry." I'm like, "We're totally off." Yeah. And it took us 2 weeks to get used to their time, and then we came back. Yeah. So now I wake up at 3 a.m. here, hungry.
Yeah.
And I'm like, "What's going on?
What is wrong with me?" Yeah, no, that's weird. I'm not a big fan of a 10-hour change.
Yeah, we went through 10 time zones to get into Finland. It was 9-hour difference in Sweden and Norway.
9 in Finland.
10 in Finland.
10 in Finland. Yeah,
he's still confused.
Oh my goodness, yeah.
Anyway, great trip. We did look at some real estate while we were there. We found out that these countries operate as companies. Mm-hmm. And especially in Sweden, they have a board, a government board.
Yeah.
The government board, and they own over 60% of the real estate in Sweden. Yeah. So even their real estate is socialized.
So how much housing is that? Like the city of Salem, maybe?
No, it's crazy.
It was a lot.
When we were in Stockholm, you'd stand, and first off, it's 1,000-year-old cities, right? So you stand in the middle of an intersection, and you look in every direction. It goes for miles, and every building is like the same exact height, the same exact style. They're a little bit different color.
Yeah.
But they're like 6 stories tall, and they go for miles in every single direction. I'm pretty sure that's where all the people live.
Yeah.
I was going to say, so it's all centered into that.
Yeah, it was nuts. Yeah. It was cool, though.
It was
I was enamored.
I mean, they don't have a large population.
Stockholm's about 1 million people.
Okay.
I thought Stockholm was I thought it was like close to the size of, or bigger than Portland.
It's bigger. I think Portland's almost 1 million, close to 1 million.
Well, Metro's 1 million.
So it's about the size of Portland, but you cannot imagine a city more different than Portland.
No, it's
the way that it's designed.
Yeah.
And it's just so much better. It was built out better, but also they've had 1,200 years to do it. So Portland has had substantially less time to figure it out.
Well, no, it's just planning in general. Like it's American planning just changed everything in the mid-century.
But
yes.
you're not going to drive a car. They charge you a tax if you drive the car during the
Yep.
day. So you're in a train, you're in a bus, you're in a boat, you're getting around
Dude,
town.
think about it. They've got 10 times the amount of history, 1,000 years versus a few hundred years of density of having to force people into efficiency.
Figure
That's
out what
urban,
works.
It's efficiency, and that's why urban planning is like the next future because we have to figure that out.
Yeah, I would say I've heard talk of like smart cities.
Mm-hmm.
I would say there are already smart cities. Like I would consider,
Oslo,
especially
sure.
Oslo.
Oslo is better than Stockholm,
I think you
even.
could live down there and just walk.
Mhm.
You could walk
You'd
to
never
work.
need a
walk.
car.
You would
Oh,
never.
yeah.
You would never need a car.
Dude, moving to Salem shook me because that's how
You're
it was
driving
in Portland.
everywhere.
You gotta get-
I was
yeah.
walking a lot. Yeah. And
Now
I
you
have to
use
get
your
in my car.
Now you have to golf every day.
Siri, I love you for thinking that my office is at the golf club. It's just-
Every day you get in your car.
it makes me so
It's
happy.
9 minutes to Creekside.
She turned on when she
So
heard
funny.
that.
Yeah, she did.
Yeah, it literally comes in. Yeah, Creekside.
I will say, somebody asked me towards the end of the trip, what's the one thing you can't wait to get back to when you get home? And I said, I want to drive my car.
Oh my goodness. I know.
I cannot wait to drive.
I do like driving. I realize that. Yeah.
That's the best part of flying back in, and then you drive your car home, and you're like, wow, this feels different.
Yeah.
Well, it's a lot of fun. You know, real estate affords us some freedoms, and I think that to appreciate, take a moment of gratitude to be able to do things like that. We wouldn't be able to do it without being Deal Junkies. So, and to travel with these guys, Dane and Trevor and their girls, they're just the smartest people I've ever been around, and besides you, Mike. And it's just, I'm tickled pink that they want to hang out with an old guy like
That was
me,
fun.
because
I was thinking about that.
we have a lot of fun together. We would have had more fun if Mike was there.
That's
but
true. It's true.
Next trip.
I was like, I think my best friends are way older
You
than
guys
me.
sent me a video. I love the video. Like from the car, Dean sends me a video, and then the reindeer.
Oh my
That
God!
was so
That was
funny.
amazing.
No, that was theatrical timing.
Sent Mike a little love video
Yeah.
right when we saw the reindeer.
Yeah.
out in the
I
road.
flipped the camera. I was like,
Yeah.
it's a reindeer.
Perfect timing. Like, that was awesome.
Sorry for your ears. That was
All right. Well,
Let's
we're back. We're excited to be back. And so, what are we going to talk about today? We want to do a little econ update.
Yeah, we'll get through the Fed cut quickly,
Yeah.
and then kind of first time home buyer down payment. I think we'll chat a little bit about that. We got deals to talk about.
Home.
Date.
What'd you call it before?
DPA,
DPA.
down payment assistance, first time home buyer, DPA.
which already exists in different ways, but I'd
That's
like
a great
to
way
hear
to
what
frame
you're
it.
talking
There's
about.
ways to frame it, like a 100% USDA loan is essentially a down payment program
Yeah.
through the loan program. But we're talking about policy, government
Yeah.
policy, Biden's old policy, and like Biden. I think we forget about it, but that was a big thing prior to COVID, and it was really a big thing in some of the early spending packages of COVID, and then it just flew away from a talking point standpoint. So we'll speed through it real quick. You know, my thought about it is because the concern from an economic standpoint that all the people on the left hate all the people on the right for is, well, the people on the right say this is going to blow up prices, this is bad for economics, you just inflate because you give artificial demand, which I believe in that premise. However, if you look at down payments, different than interest rates, right? So that I agree with that sentiment from an interest rate standpoint, because you're not actually doing anything for them from a real true wealth building standpoint. You're adding fuel to the fire so you can compete better, but you're not changing the atmosphere at all. And in a world of high affordability, interest rates fuel a fire that's already there. What's different now is we're in an environment of really, really low affordability, and we're not giving them interest rates, which may or may not be good. We're giving them equity. Right, so if you think about it, what is a home buying down? This is home buying, whatever, DPA.
Down payment. Yeah.
Yeah, it's an equity equalization, right? It's a wealth thing. It's not taking from someone and giving some from one. You can say it is because the government's doing it, but really it's a wealth equalization stable. And so rather than say, hey, we want you to compete better, we want you to get in more debt than maybe you should be in because we're artificially keeping your payment down, here's what we're actually going to do. We're going to give you equity. So now that you can lower your equity in the house that you buy, it's not going to change your down payment significantly like an interest rate would, but it allows you to get in
Your monthly payment.
Your monthly payment,
Okay.
yes.
So
Excuse me.
this isn't like a 0% down program. This is like You buy the house.
Yeah, it's a tax credit program, right? So when we did the first time the DPA program after the recession, it's just you buy a house and then you get refunded on your tax credit the next year via tax credit on your tax return the next year. So you have to pre-fund that down payment, you get reimbursed for it. So that program didn't do much for buyers because you had to be able to afford a home.
Right.
And what is changed here is not just the amount, 10 grand to whatever, 25 grand they're saying is, it's pre-funded, right? So now you actually have the ability to go transact. And so think of it this way. It's like, it's better than a college loan, in my opinion. They're giving you money to then go put into our economy, into the seller's economy, which they can then, into our economy through the seller, which they can then disperse, getting more transactions going, which is really what we need. But more importantly, you set people up for success in their home. And I think setting people up for success in home ownership is a good thing for Americans.
If you hand somebody, though, 25 grand, doesn't it just make all the buildings go up in value 25 grand?
No, because we're talking about down payments, right? And so you're not just saying, hey, go tack that onto the price. We're saying the price is what it is. And what the other part of this is, I'm also a firm believer that values have inflated a little bit too high, and I don't see the upward pressure on prices that I think people see. I don't think rates are screaming back down to under 5.5 and to under 5. I think rates are going to level out a little bit. I think affordability, what are we in Portland? We're like 85, 87%. When are we going to get to 100?
Yeah.
Right. And the first time this program came out, we were like 120. And so it's a different framing and a different marketplace with different contexts. We have way more supply than we do now. Then you also think about it from a builder and a supply standpoint. Well, if I'm a builder and I know that first-time home buyers now have programs, you can now kind of go target some of those things. So I haven't really thought about it yet. It's just kind of an idea I put out there, and I put it out on Facebook, so I get some smarter people saying some comments. Which
I haven't thought about which piece of it.
Just really what the economics piece of it is. So so at what point does affordability too high, then now this has the bad economic effect. And so my opinion right now, what I'm thinking is, and I haven't fully fleshed out, is the initial statement is this is bad, it's inflationary. I don't think it is.
Well, you take a lot of people who normally would not be in the buyer pool and you add them to the buyer pool. So if you don't add a lot of inventory to that equation, the prices will go up because you'll have more competition.
Maybe.
That, right?
I don't, it to me, it's different because our buyer pool thinks monthly payment. Our prices are based more off monthly payment. And I think that is much more inflationary than someone just having some liquidity that they didn't really have. I understand the sentiment, and
you're saying if they artificially lowered interest rates, it would cause more inflation.
Yes, correct. Because now affordability gets pushed up, and that's what's not happening here.
So why does a buyer need to have a down payment to begin with? Like, what's the purpose of it?
To show they can make credit-worthy buying decisions.
I mean, so
right? I can save 20 grand.
In
right?
a normal
I can save
bank,
25 grand.
If the bank wants skin in the game, they're going to want 20-25%. But you get like these FHA loans where you only have to put 3.5% down. They've already subsidized that market.
Yeah.
But for whatever reason, they decided, well, we don't want to make it zero. We want to leave that. I mean, I've heard that there were other programs that you could take a little bit higher rate and not have to put in 3.5%.
Yeah. So right. So they have these government loan programs that allow you to get back in, but this is different. This gives you equity. You can go choose the lender you want to borrow from. You don't have to get PMI, right? So say this way, say you're like, hey, I can't afford my payment because PMI keeps me from the DTI, but I got a 17% down payment and then this assistance gets me over 20. PMI is gone. I can afford it. Right? That person isn't going to come into the market and say, I'm going to pay you 50 grand more because I got down payment assistance. They're like, thank you, government. I can now go pay 400 grand for the house I want to pay 400 grand for. And I think that that's more of what this is doing right now than it is really adding fire or fuel to a potential fire. That's the context that I think the nuance is different.
I understand what you're saying.
Yeah.
And I agree with it. I would like to say fundamentally, and what he mentioned is you're just bringing more buyers into the game. And so from a fundamentals level, it will increase prices. However, I agree that it won't increase prices at the same pace that interest rates going down does because they care more about payment. You care more about payment. Right. So even if you have the money in your pocket, you're still looking at what do I make every month and what can I afford every month. And so even if now you have the down payment, sure, there's going to be more buyers, which is going to take up prices. There's no question about it. It has to. There's more demand. That's all it is. Supply hasn't changed. There's more demand, right? And so it will increase prices, but I don't think that, what happens during COVID where every house price doubled because payments split in half happens. I don't think that happens.
And it's the intensity. And this is why I want, like, nuance and context matter so much to me. And this is a good segue into the Fed. Life isn't like how it used to be. And we just say that this is what the textbook says. And the instant reaction is this is inflationary. This is bad. And I think the more context of history and economics and politics that you add in, you realize that the textbooks aren't speaking to life the way that they used to do. And now let's get into the Fed cut. Specifically, in my mind, I'm writing something on this, is the yield curve and the neutral rate, right? So it seems like the talking heads right now are framing the Fed cut. It's the neutral rate. We got to get to the neutral rate. And actually, the scariest comment I saw from one of the speaking heads at the Fed was a governor that I don't recognize his name. He's like, we are way above the neutral rate and we need to get down to it. That's kind of the scariest state. But I don't think it matters. I do not think an inverted yield curve matters.
What's a neutral rate?
So the neutral rate is essentially that magical Fed rate that if they hit the neutral rate, they're not slowing the economy, they're not speeding the economy.
They don't know what it is.
No one knows what it is. Economists can make assumptions. The Fed governors and all their staff, they study this every single day. And so they all have their assumptions. They all have different assumptions. And that's why we have a dot plot. And that's why they have votes. And they all have different opinions. But when you look at, again, I'll go to the inverted yield curve. Okay, have you heard anyone talk about the inverted yield curve without mentioning 2001 or 2008?
Only because they claim that every recession was preceded by an inverted yield curve, right?
And when was the last time we had a recession?
08. Well, unless you count COVID.
So not counting COVID, when was the last time we had a recession?
08.
And then 01. Okay. How relative is the yield curve back then contextually compared to now?
Well, I think that every recession, at least the last 6, they say that we had an inverted yield curve prior to every recession.
Yeah.
Oh, relevant?
Relevant, yeah.
Relative.
It's
one indicator they look at that they believe has 100% accuracy.
But what makes up the inverted yield curve? What are we talking about?
The 2 and 10-year Treasury.
We're talking about bond market activity.
Which is all upside down right now.
No, well, it's just significantly, fundamentally different, and it will never be like 2008, and it will never be like 2001.
Why?
Because of the Fed's activity since 2008. So how can we say this is what it looked like in 2008? This is what it looked like in 2001.
Because they changed policy?
They changed policy.
The rules have changed.
The rules have changed. Yeah. And so what I'm looking at, and this is what I see, is like you can't point to that and say this is an indicator of what we have now. We have a lot of documents saying that this was a really good indicator in the past. We have nothing that shows that that was a good indicator for anything in the past 16 years. And this is what I struggle with the talking heads. No one thinks anymore, in my opinion. You just go back to, well, data says this, data says this. When do we recognize that nothing is the same after 2008? And when do we recognize that it won't go back? Think of it this way. All the Fed has done is take off half of the balance sheet expansion that it created during COVID. And it doesn't want to take much more off, right? That's on top of everything that they printed prior to that and everything they couldn't take out of their balance sheet in the taper tantrum of the mid-2010s. We're not going back. Their balance sheet is not changing. Their bond market activity is not changing. And so if their bond market activity is not changing, that's what changes the yield curve. Their interest rate gets more diluted and more diluted and more diluted. So what they do with interest rates has less and less effect the more activity level they have in the bond market.
Isn't that a good thing?
I think it is, because it actually gives them more control over the economy.
Because it's less.
Yes, correct. And so we're still focused on interest rates, but the interest rate has diluted, which is great because it's not a great tool, because interest rates tell the banks what to do. It tells the investors what to do. And then the Fed hopes that the banks and the investors react to how they want them to do. But if they have bond market operations and they're just buying and selling bonds, artificially increasing and decreasing or changing the competition between supply and demand in the bond market, those are the rates that affect consumers and like that are everything that actually affects us, who the Fed is supposed to help. They do that through the bond market operations. And so what I hate about the discussion right now is everyone's talking neutral rate. Everyone's talking the inverted yield curve, and their interest rate doesn't matter anymore when it comes to that. Now, the neutral rate matters, like that kind of matters in the context of what you're telling the markets and where to push their money. And so that's where policy doesn't matter. At this point, their policy decision, what they cut, when they cut, that doesn't matter. How they talk to the market and how they keep the equity in the buckets and the places they need the equity to be is what matters more. And so that's where, if you look back over the past 24 months, every time they've talked, after a big move, it's been opposite of the move. Doesn't matter if it's down, doesn't matter if it's up. Their comments are opposite of the move, steering it back into equity. We like you where you're at. You can make small moves. You can move in and out of stocks and bonds a little bit. But if you make a big move, we're going to talk tough oppositely, because you just need to be on the sidelines. Because if you're on the sidelines, they can do their bond market operations to keep rates where they want to the actual consumers, the business owners, the people that actually need to have stability, or where they can actually control the flow of money through our economy.
It's a little smoke and mirrors, really.
Yeah, absolutely.
I mean, if you think about the last couple of years, this chokehold that they've had, everybody points to the highest interest rate hikes that have happened in history.
Yep.
Really, the reality, like what you're saying, is behind the curtain. What they're doing with quantitative tightening and quantitative easing with their bond buying activity has a lot more effect on the market than the interest rate does.
Yeah.
Is there a reason why they keep us talking about rates and they don't talk about quantitative easing?
I mean, that's okay. So that's where one.
Because that's the new normal.
Yeah,
this
I don't think
about.
Well, and this was where I go back to ChatGPT, and I'm going to give another shout out to my friend Jay Scott. I just love him. Like we've had this conversation as well. How does the Fed actually print money? I cannot get ChatGPT to actually tell me what we think they do. So the Fed can create and destroy money. The government can create, destroy money. But it's not written down in a textbook, right? So their bond operations is modern monetary theory playing out in life. So we have all these pre-Keynesian and post-Keynesian textbooks, right? So pre-Keynesian is what everyone talks about. That's what everyone believes, but that's not what's happening. And so the textbooks that we pull from are the pre-Keynesian ones, because those are not theory. This is what we believe. This is what capitalism is. And so post-Keynesian looks like, you guys are crazy. You don't know what you're talking about. So there's nothing to really document the statistics behind it. And the first thing I'll point to is if you go to the Fed's actual websites and you pull up their balance sheet, it goes back to 2008. They had operations prior to that, but they don't have it on record on their own database. I've done search after searches. I found a Stanford professor handwritten ledger that went back to like the early 1900s. That was how he figured out how to like watch their balance sheet, and then right. And so now it's published. Now it's a big deal. Now everybody knows about it. Now that's the real tool that they use. And here's where Bitcoin comes into it, the ledger. And so in August, they have the Bitcoin reserve bill has been put on the table for our government to vote on. So Bitcoin has two things. There's Bitcoin, the currency, and then there's the ledger, right? The value in a Bitcoin reserve is the transparency in the ledger that can create.
You're talking blockchain?
Mm-hmm. Blockchain technology. And so...
And that's not just Bitcoin. That's all crypto.
Correct. Exactly. But that's what I think they call it the Bitcoin reserve. They call it the Bitcoin reserve. They probably label Bitcoin because it's the most stable. Yeah. But that's what... So you've got the ledger, and then you got the technology, and then you have the money portion of it. So... there is no transparency. So that's why we argue about interest rates, is because the lack of transparency. And I think the lack of transparency comes from, we still think some textbooks are bullshit and they're a theory, and we still think some textbooks are relevant and true, even though that the context of the economy is significantly different than the old textbooks and is much more true to what the new textbooks say.
So do they work off of a new textbook we don't have access to, or do we just not have the new textbook yet?
No, I think again, the Fed, I think, is just working off monetary policy. And then as talking heads is observers. So think of the Fed as the arena, and then everyone else is just observing the arena.
So they're trying to figure out in real time what this new normal means and how to react to it.
Yeah.
Because they can't really fall back on old data.
Correct. So think of it this way. Are you thinking like an economist that looks at supply and demand and credit? Or are you thinking like an investor that thinks about equity? And I think that's the distinction I've had. So like, I'm not an economist. I hear these economic things all the time. Like, oh, that makes sense. Like, don't know any of these things, but I think like an investor. And what I do is I listen to interviews on Bloomberg of the biggest traders in the bond market. And you listen to both sides and you learn their verbiage, and then you hear their positions they make and the verbiage they use. And then you can say, oh, well, I see the context you're using. I agree with that, or I don't agree with that. And then you can see the other side. I agree with that, or I don't agree with that. But if you look in the bond buyers, if you listen to them speak, they know what's going on. You listen to the traders, the people that run the big trading desks, they know exactly what's going on. We are in modern monetary theory.
Well, in the bond market, speaking of that, they're baking in a lot the interest rates to go down faster than what the dot plot shows, or at least what the talking heads
How do we know?
Well, just based on where the rates are, just where the yields are, right?
But how do we know?
Because one thing very interesting, when you made a comment in the last meetup, the SRE meetup, when you said you predicted a 75 bips drop, and you thought that the 10-year, I think you said you thought the 10-year would actually go up, or it would stay flat. And so we got a 50 bips drop.
And it went up.
Mm-hmm. So you were close. It did go up. So why does that happen? Because the market had already priced in.
Because some people have already made a bet that it's going further, and some people have made a bet that it's not. And so it's just a reconciliation of bets. And so like here again, I come out immediately and I hate the people, oh, the rates went up. No, they didn't. They went up a little bit. Yes, in context of your 1-day trend or your 5-day trend, you can see that. But if you scoop out to 3 months or 6 months, you cannot tell me rates are going up, right? And so why do they argue about interest rates? Because you can on a daily basis. Right? Like you can't argue about their decision on a daily basis.
Mm-hmm.
So,
and they didn't mention anything about quantitative easing or tightening.
They didn't change anything in their words. Their words in September were no different than their words in March.
Except for he talked about recalibration.
Well, okay,
so it's changing the rules again?
Yeah, well, he said the change is clear. So that statement, the statement that we pulled up on our podcast, that was the only thing that was different. But everything that followed is the exact same thing, because everything that followed says we are data related. The only thing different between September and March, 6 more months of data that say it's time. That is the only difference.
What's up, Deal Junkies? This is Trevor. I just wanted to let you know that we want to help you do deals. Because of that, we put a link in the description of this podcast episode where you can click it and book a call and talk to us. Go ahead and click that link and let's talk about some deals that you want to do or you are doing currently.
So when you talk about the IKEA tool and the power drill, we got just a little. We got a 2-turn tweak on the IKEA tool.
Yeah, and nothing chained on the power.
The power drill is just still sitting over here. We haven't touched it yet.
Yeah, well, and here's what I actually love about it is right as we're talking about the Fed cut decision, a bigger decision came out, which was they just said, you know what? 18 months ago when we told all the banks we're going to increase your reserves by 19%. We're not. We're only increasing by 9% now.
And they did that on purpose.
Yeah.
I mean, that's steering the market through work.
And here's the other thing, like bank earnings. So this is something. So again, now credit defaults. What's more important, the fact that our credit default rates are going up or the fact that banks are prepared for it?
Probably that they're prepared for it.
Yeah, right. So what I remember, and again, I just talk about what I see. What I saw happen immediately in COVID was banks started stockpiling cash. Their earnings went down, their stock values went down because instead of creating earnings, they stockpiled savings.
They're hiding out.
Preparing for defaults.
Yeah.
And then, we're not concerned about defaults. We'll buy back our stock values go up, right? So banking has so much liquidity. It's not 2008. The banks don't need a loan. And I hate the bailout because it was a loan. They paid it back with interest. They don't need that anymore. They'll get it if they need it, but they don't need it because they have so much damn capital.
And that's what's different about coming out of this whole COVID, post-COVID credit crunch cycle that we're in now. Yep. Whether it's a real recession or it just feels like one, there's so much more equity. There's so much more money on the sidelines, and they've printed so much money, or whatever you want to say. I mean, they created, on the ledger anyway,
Yep.
a lot of money during COVID. 40% of all dollars printed in all time.
Yep.
So that money's got to flow into the market at some point, and
Yep.
some of it did immediately, and we've talked about this in the past at length, but it's only a small percentage.
Yep.
And so that's got to make its way down to what we're doing relatively soon. And the people I'm talking to are saying they think, if you're interested in where rates are going, because that kind of drives transaction volume for us as brokers, I hear people saying they think rates are going to go down as fast as they went up, and that we're going to there's a slingshot effect that's coming on the other side of this, partially because of all the pinned up money.
I don't believe that, because the pent up money is in assets. It's not in inflation. It's not in the environment. Maybe if that money gets thrown into the bond market, rates will go down, but I think it's going to be the short-term rates more than it'll be the longer-term rates. The other thing is what doesn't get talked about. I think one reason why September was different than March from a data standpoint is China's been struggling. Mm-hmm. Like coming into the year, China was a big threat because people thought China was going to come out of where they were at. They would spend more. They'd create global demand. That's inflationary. Well, guess what's coming back? They just stimulated the Chinese economy, and they've stimulated the Japanese economy recently, right? So now you can't just look at our world. You have to, but you also need to think of the other influences. So I don't see a world where the Fed's like, yeah, we're going to get down to a 2% Fed rate. I don't see that. Like even the market's predicting 75% by the end of the year. I don't see that. Like what I'm writing right now is I don't see 2 decisions to cut by the end of the year, and if they do, maybe one of them's a half.
It may not matter though if they're not gonna change their quantitative easing.
Right, exactly, and
tightening.
Exactly. So, and my statement is the cut is theatrical, and it's actually in context of that slide I brought up in the presentation. And if you look at the slide, I had 3 notes. It said it was all job market related, and it was if this 0.25, if this 0.25, if this 0.75. And I don't put a lot of thought into those predictions. But now if you look back, it's like, well, that makes sense. If they did a 0.25% cut, that's not enough. You have all the people that are complaining about the job market sucks. You're not doing enough. They are getting really pissed off, and you see movement in the market. If you do a 0.75%, and the other side, if you do 0.25, then all the inflationary people are like, or the people that are concerned about inflation are like, yeah, we are concerned about inflation. The Fed's concerned about inflation. Creates problems, right? If you do 0.75, man, they're afraid of the economy. They're afraid of the job market. They have to pick it up. But if they do 0.75, then see, we're fine with inflation. So 0.5 is kind of threading the needle when you think about the talking voices and the equity they needed.
And they also came out with a lot of language around it that they're not worried about recession.
They're not at all.
Yeah.
At all. And then this is we'll wrap it up here. So this is why 2008 and 2001 don't matter, because you look at what did they have in the coffers in 2001? They didn't have it. No. Rates were already low. They didn't use their balance sheet. Okay. 2008, they didn't have it. They were able to move rates down, but not 5%. And we had to politically war over giving banks a $200 million loan or whatever it was, the TARP funds,
Way
right?
more.
It was $700 million. It was not over $1 billion. It was less than $1 billion.
Oh, like bank by bank?
The bank bailout loan.
Like individual banks, though.
No, the bank bailout loan, the TARP funding was, how much was it?
I thought it was billions.
Maybe it was billions.
No, it was definitely billions, because Bank of America got bailed out for like $15 billion. I know that because that's what Berkshire put into it. Yeah, that's when Berkshire bought Bank of America.
We're gonna fact check.
We should fact. I wish we did that. But
2009 letters to shareholders.
Significantly less than what we've seen in the past few years. And so again, political will is significantly different now than it was then. So I don't think you can look at 2008. I don't think you can look at 2001 and say because this or 86 or whatever all those other years prior to it were.
443.5 billion.
Billion?
Yeah.
Okay, so it's less than a trillion.
Half a trillion.
Yeah. Okay, but still, that again, a half a trillion.
They paid it back. They paid it back with
instead of $3 trillion during COVID.
Yes.
Oh, yeah, it was 3, wasn't it?
3 was COVID. Yeah, 2.9.
Okay, so
just fun.
I'm lost on the Bitcoin part.
But that's also
how does Bitcoin play into this?
I don't know if I can do that.
No, we don't want to get into that.
I don't think I
was
do
just-
it.
I was trying to- I was answering the question of why do we talk about
Bitcoin?
I don't know where that came from. We were
because
talking
you
about
asked the
Bitcoin.
question of
No,
why
I
do we
know.
talk about interest rates? We talk
Oh.
about interest rates because we don't actually know what's happening, so we can talk about that.
Bitcoin. is
Bitcoin
confusing.
would add clarity to what we can't.
But
talk
you were saying that they passed something in August about a Bitcoin.
No, they just made a bill, a proposal.
Mm.
A
About
proposal.
Bitcoin
passed.
reserve.
What is the proposal?
One of the senators made a proposal to take
A
to
fund?
trade some of their balance for the U.S. Treasury to trade some of their cash into Bitcoin, and instead of holding cash in reserve, hold Bitcoin in reserve.
Oh,
And so then you are now adding transparency to their ledger. Problem is that's not the Fed's ledger, and it's the Fed's ledger that we want.
I thought they were talking about
transparency.
creating a U.S. government cryptocurrency.
Oh,
That had been proposed, right?
Sure,
really?
To go digital
I don't.
with the US
Here's the thing
dollar?
about I just look at crypto.
Oh,
the
I did hear that actually.
digital dollar.
Yeah.
The technology is great, but who ultimately controls it matters. And what the crypto is not decentralized. I'm sorry, how many people own it? The people that own it are a few. It's not decentralized. It's actually more centralized from a concentration of
Sure.
wealth than the dollar is.
And I don't see the U.S. government ever signing up for something like Bitcoin that has a limited number of, I mean, it has to be.
Yeah, go do a bunch of transactions we can't tax.
Yeah, we got to be able to manipulate it. We got to be
Yeah.
able to track it. We got to
Yeah.
be able to tax
And
it.
so by the time Bitcoin flipping its huge valuation, there's going to be so many things that indicate it's on the horizon that then you can get into Bitcoin, in my opinion.
You hold Bitcoin?
I don't. I just like real estate.
Yeah, me
Why?
too.
I can manipulate it. I can
In like
control it.
2021, I had a
Yeah.
bunch of crypto. That's when I was mining.
I will
crypto,
say
too.
this, like I was walking the other day, there was a sign in a store that said we take Bitcoin. That's when you start changing and start buying Bitcoin.
Becomes
is when it
easily
yes.
acceptable
Exactly.
to go
It is
spend.
Yeah. And I'll say this, I'm watching Bitcoin. Fuck yeah. I'm not going to miss out on a change of currency. Like at the end of the day, okay, so tenants start paying me in Bitcoin instead of dollars. So there's that hedge by having assets that people have to pay. So you have that hedge there, but you're going to want your cash and your liquidity in Bitcoin when that flip happens.
You're going to want it in some sort of.
Some whatever coin it's going to be.
Yeah.
To me, that's just a stupid bet now when I can just make a good bet on myself.
So we've talked about other countries moving away from the dollar as a reserve currency. Does that threaten?
No country's moving away from the dollar as a reserve currency.
I know that's I know that's not.
They
gonna
did.
happen.
Countries are
You
trying
hear
to
that-
decouple from the dollar.
You see it in headlines.
Mhm.
So how does this crypto move affect the U.S. dollar if people were to move to?
So you don't have to get dollars to trade in things that have to trade in dollars. And so like BRICS is a big deal and their oil decision's a big deal because now they're trading oil outside of dollars. And so our value of our dollar doesn't have demand pumped into it just so people can trade whatever currency they have to buy dollars so they can buy oil. Right? So you have these, and it's more of a, this is so far outside of actually what I understand. To me, that's more of a speed of money than a value. But
Yeah.
you do it
I don't think it
consistently over a long period of time. There's a tide issue to it, like bringing the tide up. But
Somebody told me once to watch oil when you're watching interest rates,
Mhm.
and it seems to be like 99% accurate. So I pull up my phone, I'm looking at where the 10 years going, and it goes down, oil goes down. It goes up, oil goes up. So it's like it almost feels like our currency is based on
it's the other side of the
Oil.
balance sheet, if you think about it. 'Cause
petrodollar or whatever they call
well,
it.
the interest rates are really relative. They're an indicator of how healthy our economy is. Oil's the same thing.
Interesting.
commodities.
It's interesting because oil actually does something.
Yeah.
The dollar doesn't do anything.
No, dollar is fucking oil for transactions.
Wow.
I mean, there's a line.
Can't transact.
There's a line.
Can't transact without her oily money. How long has this been?
I don't know. That was a lot. Trevor fell asleep.
My
So where's this all going? We're gonna. I mean, how does this affect us as investors? Are we gonna? You think we're gonna be?
Yeah,
everybody's
so
feeling pretty
I
good
like
about
it.
like we're gonna start doing deals again
Yeah.
pretty soon. There's gonna be more. It's gonna be easier to trade real estate, easier to get financing. Is that you guys?
I
feel
think
that's
value
true?
creation is going to be harder.
Pushing equity.
Yeah.
Why?
because you don't have the rates helping you push equity. That's part. Well, rates push equity and cash flow because they prop up your cap rates and they prop up your cash flow. And I don't think you're going to have the market working for you the way that the market's been working for you.
Meaning rents aren't going to move as fast?
No, I think more of the interest rates aren't going to move as fast to give you equity and cash flow for free. You have to earn that equity and you have to earn that cash flow.
That's what I was going to get at. This is something that I talked about like a year ago when we talked about the issue with throwing the final whatever COVID relief payment after everything was okay already, and the issues with that, and then keeping
ERC,
and then keeping rates so low for so long, and the issues with that. And I don't think that having rates where they're at is really killing investors. Like once it's accepted as the new norm, if rates stayed right where they were or went up 1%, but it stayed that way for 5 years, it wouldn't matter. Because when you're looking at it from the perspective of like, okay, I'm going to buy a deal and I'm going to try to get we don't look at deals unless we're going to get a 20% return on it. We're really trying to do deals that we can get a 30% return on it during our hold period. So
your IRR.
Our IRR. Like, so our yearly return
metric out there.
Call it AAR.
Okay.
I mean, because we're actually underwriting to AAR, which is just average annual return. Okay. The average annual return over a 3 to 5 year period. And that's what you're trying to hit during the life of that project.
Yeah.
And if you're getting a 30% return, the difference between a 4 and 6% interest rate on the money that you're borrowing is significant because it's exponential as you get closer to zero. And so, the difference between a 6% interest rate and a 3% interest rate is the same as a 3 and a 1.5% interest rate. But to the point, if you're getting a 30% return on your deal, you don't care.
Right.
I mean, you care, but it's also easier for you to transact because you're the only one who's actually creating value. The people who are actually creating value are the only ones who can do deals.
Yes.
You can't just say, oh, shoot, I've owned this property for a long time. I have some equity. Now I can roll it into a property twice the size, do nothing, manage it worse, and still make money on it.
You're telling me you have to work harder to make money.
To make money, yeah. It's like, oh, what a concept.
I know.
Like,
it wasn't high interest rates that kept buyers from buying deals. It was
high prices.
It wasn't even that. It was the uncertainty that if I buy at this higher interest rate, what happens in 5 years when that loan expires and I'm at twice that interest rate?
And the uncertainty was magnified by the interest rates requirement for significantly more liquidity. So you had to bring more down payment.
More down.
You had to bring more risk to the table.
But the only reason that was the case was because prices were so high. Because it's based on a debt coverage.
It's the quick release in interest rates that created a huge difference in valuation.
Yeah. So everybody's wondering, on the buy side, are rates going to go even higher?
Yeah.
On the sell side, people are going, well, I don't really have to sell. I'll wait until rates go lower, and then I'll get my value back, right? And so everybody's just on pause because it's like, we don't know.
Yeah.
We don't know if rates are going to go up or if they're going to go down. Now we know they're going to flatten out, and even if they come down a little or a lot, it doesn't really matter. We know we're going in the right direction. And so now...
Or staying in the right place. That's why if it stays where it's at for 5 years, it doesn't matter because that's the world you're in.
My argument would be that if it just could stay at the same place for the next 5 years, it'd be better for us than going up and down all the time, because then everybody's trying to figure out what it's going to do.
Yeah.
What are you modeling your interest rates at right now on your projects?
6.5. Okay. When we underwrite, that'll change. That was
like you're getting your interest rate now.
There's lower than that.
No, we're getting lower than that. I'm saying, but I mean, if we're underwriting to a 6.5 and the project looks great, then I say, ooh, what if we got 5.5 in 3 years when we refied?
Yeah.
And then if it's 5.5 in 3 years, awesome. But if it's 6.5, whatever.
Agencies in the high fives right now, 5.7 to 5.9.
Yeah.
Yeah.
And it looks, I mean, if things track the way we think they're going to track by the end of the year, beginning of the year, we'll be in the mid fives.
Yeah. So I'm modeling out what I'm doing right now, and this will be a segue for in our next episode, is on the cottage cluster side, a 5.75 rate for new construction 18 months from now. That's what I'm modeling out.
That's what we're putting our cap rates.
I think that's realistic.
Yeah. That's what we're putting our
It could be better, and then it would be great. I don't think it's going to be worse.
No, I don't either.
So you don't see any risk of inflation taking off again?
Because I believe the Fed won't be aggressive. That's my take.
Yeah.
Right. And if they do get aggressive, then our interest rates will be lower, our values will be higher, and that's good for us. but then it becomes now inflationary, and then now it's like, well, maybe we need to sell, and right. So I'm trying to model all this out of a build to rent model, which creates so much freaking equity you can just sell.
So you've got two options.
Two options, yeah.
If you get to the end and it's a good time to sell, you sell, and if it's not, you keep it and rent it out until it is.
Taking all the experience and all the lessons I learned in the build for sell model, and then converting that to what makes sense in the build for rent model, and then the build for sell becomes a second exit. One of the biggest things I learned is when you build out a build for sell model and interest rates go up, you can't. You're not renting shit. Yeah, you got to sell because you can't rent. So, and then that just puts you in. You got to sell in a desperate position. You don't want to be there.
No.
So,
wow, no kidding.
Yeah.
And it's. I mean, the market's. I feel like today, it's transaction volume's down. Lending is still really, really hard for us to find. There are some lenders out there that are doing loans, but today, I mean, I feel like there's a lot of light at the end of a very short tunnel, but I feel like this is like the bottom. I mean, it better be the bottom. This is the hardest I've seen in my career so far.
I think it's been a really long tunnel. We're just close to the end.
Of a really, yeah. I mean, it's been so long.
2-year tunnel.
I met with one of the brokers that we've done a lot of deals with, not an SMI broker, but I met with him yesterday, and man, he was like, I just want to go coach my kids baseball. Brokers are just.
I need to find joy from something.
They've just been beat up a little bit. So we've been lucky to be doing some deals, but certainly not the volume that we're used to doing. So I feel we're really optimistic that things are going to turn, and I hope they turn fast.
And I would add this: the mortgage market, the mortgage rates, that's not going to be bailed out by the Fed, and it doesn't need to be bailed out by the Fed in my scenario. So the Fed can stay slow, not be aggressive, not lower rates, but then the secondary market just closes their spreads because they're more comfortable.
Yes, and I think we've seen a little bit of that risk pricing come down over the last few weeks.
Here's a thought for you. Not lowering them faster should give the spreads confidence to come down.
Exactly. The faster the Fed goes, the more risk pricing you'll see because the banks will be scared that we're going into a recession.
So if you're the Fed and you actually are really concerned about the housing market, doesn't it make sense to go low on your rates to show that you care about inflation so lenders will lend?
Go low on your rates, but then come out and say we're not worried about the economy.
Yes, that's exactly what you do.
And now we can take the risk pricing out and let them do the work for us.
Which is what they've been doing.
Yeah.
I go back to last summer, Powell, the bond market is doing our job for us.
Yeah.
They want the bond market, they want the secondary markets to do the job. They do not want to do the job.
So when I looked at the latest print, I think we were at 2.2 was PCE.
Yep.
That's the consumer index or whatever that they love to follow for inflation. So is that non-core or core? I think core. Oh, that excludes food and energy.
Yeah.
So when you put food and energy, it was like 2.7 or something like that. So they like the number. They like the number of 2.2. But interestingly enough, one of the
yields went up.
Yield went up, and one of the things that also was in the reading was housing was still went up 0.5 or whatever, right? And so it's still the outlier, and part of that it's like it's a catch-22 because it's these interest rates that are really keeping the home, or do they even bake it out of a mortgage payment?
It's the equivalent to rent.
Yeah. So, but rents haven't really gone up. So where's that 0.5 come from?
I don't know.
Rents have come down.
Rents have gotten, certainly.
It's just lag.
Soft.
This is lag. They don't see rents for 6 months. So we've noticed a softening in the rent market over the last 6 to 12. They're just about to see that.
Okay, well, again, I'll push back on that. We haven't. Definitely not in the single family world. Definitely not in the single family world. And if you're home equivalency to rent, that's single family. We have not seen that at all.
Boy, in Salem and Portland, multifamily. We in other markets like we're in Roseburg, we're in Astoria, we're in Vancouver.
Our apartments are starting to slow down. Like we've hit seasonality now.
I think we just got overbuilt, or for briefly.
Yeah,
I think
you guys are in the cycle.
In a vacuum, we just had.
But are you seeing it in the single family world? Like, because we saw it come down in the apartment world, but it really didn't affect.
I mean, it depends on if you count COVID craziness, because you took a house that used to rent for $1,500.
That's a great point. Is our inventory really got dumped during COVID? Your inventory is getting dumped post COVID.
We're not even dumping it. What do you mean?
Dumping what?
Absorbing, landing inventory now. Your new construction's landing.
Oh, that's
all the
not-
multifamily inventory has just landed in the last 18
yeah.
months.
Ours landed during COVID when there was money to absorb it.
Yes.
Yeah.
So that, I mean, oversupply obviously will do it. But if the apartment market, I mean, in outlying market, I would say Salem and Portland have finally become one market. I think they act very similarly, and the rents are actually pretty similar now, which was it used to be Portland was double what Salem was. Now we're very close.
Which is why you're feeling it more now.
Those are the two, of course, those are the two biggest markets that we manage in, but that's where we feel the most pain. Anything outside of those markets seems to be moving along like,
Nothing happened.
Almost like there's no issues. So the outskirts, the outlying tertiary markets have not necessarily been overbuilt, but in Salem and Portland we had more doors than we had tenants.
That makes sense. Yeah.
Still not bad. I mean, it's not in Portland. I think we run a few percentage points below what the market says it's doing, but I think they're at 8 or 9% is what the last survey says in Portland for vacancy.
That's like the metro, isn't it?
We run like 6, and then down here we're at like 4 or something like that. And I think Salem, if you look at CoStar, says we're at about 6%. I mean, a healthy market we call 5% anyway. I think that's what the appraisers use and stuff. So we'll get back
the
to that.
appraisers are supposed to use what the market tells them to use.
Well, it took me years to get them to start using 3% because we were under 3% for a long time.
Let's go to our next episode so I can bitch about an appraisal.
Sounds good.
All right, we're going to wrap this one up.
Yeah, why not?
Okay, great. Do you want to give a shout out to anybody? Just to Trevor for not being here. He loves Chipotle. He was so happy to he posted last night he landed in Texas and he was so happy to be in a country that had Chipotle.
It's the finer things in life.
We miss you, Trevor. We want to talk about deals with you. Get back in the studio. All right, like us, share us. Thanks for listening. We're the Deal Junkies, and we will see you next time.